So, one of the really interesting things that happened this week was the Australian jobs report that came out. Market was expecting unemployment rate to go from 3.5%, which is already ultra low, to 3.6%. But it surprised. The unemployment rate actually fell to 3.4%. And that got us thinking, looking at the data and asking the question, could the global economy be actually a lot stronger than what we're expecting? Before we dig into the numbers this week, just from a very high level, one of the things that I've learned and that I've learned from successful investors, and particularly investors that invest top down. So when we're talking about macro, we're talking about looking at the big picture themes and then using those themes to drill down and form views. One of the most important things is to have an open mind, is to form views and opinions and have convictions, but also be open to the possibility that at times you could be wrong. And when you are wrong, it's important to step out of an echo chamber where instead of seeking confirmation bias, seeking information that tells you that you're correct, it's to step out and actually explore the counter argument. And so that was a bit of a process that happened for me this week. The Aussie jobs report came out. Now, I understand that Australia is not, the most significant macro market. It's not the most significant global market. I do have a bias because I do live here, but it's a really good bellwether kind of economy because it is quite industrialized. It is significant in terms of its GDP. It is also in between the West and Asia, and we do have a lot of commodity exposure, particularly to Asia, and energy exposure and services and so on. So it's quite a dynamic economy. And so market expectations were for the unemployment rate, which is already at ridiculously low levels. We're at 3.5% unemployment rate. Market expectations were that that would probably tick up a little bit to 3.6%. And it actually came out and surprised. The unemployment rate fell to 3.4%. And there's something very important in that. The importance is that the economy is probably stronger than what many, even those optimistic forecasters, had expected. There's some very strong job creation, and wages last week were actually up. So I know that unemployment is a lagging indicator, and recent interest rate rises will dampen that. But it got us thinking that maybe we're missing a really important theme here. And it's not that we don't understand it, but I think this echo chamber where people are forming a view and that there's a big consensus, and there's probably a negative consensus bubble forming out there that interest rate rises are going to kill the economy, and they're going to kill jobs, and they're going to basically send us back into a downward spiral. That might be the case, but that is not the only case. And if we have a look at bond markets that are really important because bonds have great liquidity. It's the biggest liquidity basket, and so we can look to those markets and see what those markets are indicating. And in a note this week, I point to that and I say it's not just one employment rate in one country, but if we have a look at and see what bonds are pricing, they're pricing for rates in the US to go up a little bit more and then stay there. I know that 10-year rates have started to come down, and the gap between 2 and 10-year rates is big, and traditionally it indicates that there's a recession coming and everything else. But if you have a look at 5-year rates, 5-year rates are back where with a 4 in front of it. And in the note, I've put a chart going back, and I've gone back to kind of 2005. And the reason why I did that is because in 2008, we did have, bond yields pull back, but they came back because of a financial crisis. So what we had in 2008 was a financial crisis. In 2020, we had a pandemic, and we basically had a V-shaped recovery. And so we can't really go to that. If we want to have a look at long-term trends, we've got to go back and have a look at, where we've been in the 90s and post.com, and going into really the first of the financial crisis, which was the global financial crisis. And it's not uncommon to have bond yields at these levels. We're probably going back to what was considered normal for 5-year money, and 10-year money. And so there's a lot of angst in the market that, these rate rises are going to kill and destroy. And the point that we're making in a note this week is, well, hold on, not necessarily. Not necessarily. We could be missing a really important theme here, in that the economy is super strong, job creation is super strong, and rates are rising because the economy is strong. And maybe the economy can withstand these higher rates and learn to live with them, of course, in different ways. And so the point we want to make there is that different economies are going to behave in different ways because of how interest rates impact different economies. So let's take the United States, for example. Most mortgage holders, and if we drill down at the individual, retail, residential property investor level, when you go out and get a residential loan in the United States, you're usually going out and getting a long-dated fixed rate. So you fix long, and when interest rates rise, it only impacts the marginal buyer. We're not saying there is no impact, but the impact is to the person that's marginally buying. Those that have already purchased or been in the market, you would expect, or you could form a view that they have already taken advantage of low rates. If you have a look at the UK, Australia, and Canada, for example, it's different. You have a lot more borrowers on variable rates. And so that means that interest rate policy in those three central banks and many other central banks around the world, the US is really the exception, but interest rate policy is going to be different. Timing is going to be different, and you're going to have a different impact to the real estate market. If the US Federal Reserve wants to continue raising rates, it's probably not going to translate into the same way for the Reserve Bank of Australia or the Bank of Canada. And so that's the point we want to make, in that if the jobs market is strong, the economy is stronger, you're going to see this play out at different ways in different economies. Again, we bring back our Australian bias and we say, if you take the housing market in Canada, for example, and compare it to Australia, we believe that the housing market in Canada is probably more inflated. The unemployment rate in Canada is higher, and Australia is probably better placed geographically and economically to benefit from China opening up. We're not even talking about the politics there that transpired this week. We're talking purely as an example of how you can play different economies and different asset classes against each other. But one of those examples is taking the Australian dollar against the Canadian dollar, and perhaps forming a view that Canada is going to have a much more rocky road in adjusting rates and the impact on its housing market and its employment market than Australia, that seems to be going great. The unemployment rate is very low. The fiscal position is contained, and you have a central bank and the Reserve Bank of Australia that's very mindful of the impact of its actions on borrowers. So we then drill down and talk about asset allocation, and perhaps maybe your 3 or 4% risk-free rate is the new normal, at least for the next 5 or 10 years, based on what the bond market's implying. And if 3 or 4% risk-free rate is the new normal, maybe add another 1 or 2 percentage points for the US, call that 5% in the US. Really, that should dictate your asset allocation, and the way that you're allocating your portfolio towards cash is very different to when cash rates were at zero. And the way you're thinking about stocks and the type of risk exposure you have in your portfolio is going to fundamentally change. Just because interest rates are rising, it doesn't necessarily mean that all stock valuations fall. if you're in a business that actually has pricing power and a business that can actually take advantage of strong employment, then you might have earnings growth 7 to 8 or even 9% per annum. That means you can pay, your 15 to 20 times earnings because you have that earnings growth in there. So again, we're looking through the valley and saying there are these views out there, but we don't want to miss what the market's telling us. And the market's telling us that jobs are really strong and there's going to be a lot of beneficiaries, and asset allocation should actually look towards that and not just wait for a pivot. So that rounds us out for today. I encourage you to jump in and have a look at the note on peteresho.com, which is titled, "What if the global economy is much stronger than we think?" I also introduced the model portfolio that we're going to be running. I give you a sneak peek of that. We're going to have more of a consistent update to that portfolio next year, but it gives you a little bit of an idea as to that asset allocation, managing risks, and we bring it back and say jobs are key. Let's keep our eye on the job data, and let's have that in terms of where we're investing and how we're thinking of our investments next year. Have a great week. God bless, and I'll talk to you next week.